Think about the last time you did your taxes. It's late. You've got tabs open. Your W-2 is staring at you like a scoreboard. You see the big number. Your salary. Your total pay. Maybe your household income if you're filing jointly. And then that phrase pops into your head. Roth IRA has income limits. So you do what a lot of smart, busy people do. You make a quick gut check decision. I'm over the limit. You close the tab. You stop researching. You don't open a Roth IRA. You don't contribute. You move on, not because you verified the rule, but because you assumed the rule was based on the same number you see on your paycheck. Here's what most people don't realize. The income limit everyone talks about usually isn't the number you're looking at. And when you disqualify yourself early, the system doesn't correct you. It quietly benefits from you giving up. Let me be clear about something. The Roth IRA income limit is not based on your salary. It's based on a tax calculation called MAGI, Modified Adjusted Gross Income. That's a specific IRS number used to decide whether you can contribute. Your salary is what you earn. MAGI is what the tax rules count after certain deductions and adjustments get processed. Those are the little, before taxes, choices that change your tax return even if your paycheck still feels big. That moment you recognized a second ago, staring at your W-2 and deciding your band? Here's what was actually happening beneath it. You were comparing the wrong number to the cutoff. And the cutoff itself usually isn't a hard cliff. According to the IRS's Roth IRA limits for 2024, if you file single, your Roth contribution phases out between $146,000 and $161,000 of modified AGI. If you're married filing jointly, it phases out between $230,000 and $240,000. That word, phases out, matters. It means partial eligibility can exist in the middle. So the trap is simple. You see a high income, assume 0, and you never check the actual MAGI calculation or the phase-out range for your filing status. And once you see how MAGI is built, you realize it goes deeper than just one number. So before you decide you're too high income, you need to understand the two numbers you've been mixing up. Salary is the number you negotiate. It's the headline. But Roth IRA eligibility runs on AGI and MAGI. AGI means adjusted gross income, basically your income after certain adjustments, the number you see on your Form 1040. MAGI means modified adjusted gross income, your AGI, with certain deductions added back for this specific rule. Vanguard summarizes those add-backs as things like a traditional IRA deduction, student loan interest deduction, and certain foreign income exclusions. Here's the twist. Two people can have the same salary and totally different Roth eligibility. Take someone like Marcus and Priya. Both make $170,000. Marcus ignores pre-tax options because he thinks they're extra. Priya uses them like tools. In 2024, the employee contribution limit for a traditional 401k is $23,000. And if she has an HSA, a health savings account, only available with certain high-deductible health plans, the 2024 limit is $4,150 for self-only coverage or $8,300 for family coverage. Those contributions can reduce the income that flows into AGI, which then affects the MAGI calculation you're compared against. What does that mean for you? Your paycheck can scream, over the limit, while your tax return quietly lands you inside the Roth phase-out range. Or at least closer than you think. So the right move isn't guessing. It's checking the right scoreboard. And once you see that, the next question becomes uncomfortable. How often are your everyday decisions accidentally pushing that MAGI number up or pulling it down? Now you start noticing something. Your Roth eligibility isn't just about what you earn. It's also about what you root and when. The biggest MAGI movers are usually the boring payroll choices you set once and then forget. Pre-tax 401k contributions. HSA contributions if you're eligible. Certain deductions that show up as adjustments on your return. These don't always change your lifestyle day to day, but they can change the tax number that decides whether your Roth IRA contribution is allowed. Picture a real April scenario. You finish the year thinking you're out. Your household income was strong. Maybe a bonus hit. So you assume the Roth door is closed, but then you run the numbers the way the IRS actually does. For 2024, the IRS says married filing jointly gets a phase-out range between $230,000 and $240,000 of modified AGI. You're not comparing that to your salary anymore. You're comparing it to MAGI. And if you were anywhere near that range, a few choices could be the difference between full, partial, and none. Even the IRS's own definition of MAGI matters here. It's generally your AGI calculated without certain deductions, including things like the student loan interest deduction and an IRA deduction. The implication for you is simple. Planning beats guessing. If you wait until tax time, you're reacting. If you pay attention during the year, you're steering. You're choosing whether your money flows through pre-tax channels that can keep your MAGI in range, instead of blindly drifting above a line you never actually measured. And there's one more piece people miss that makes the "I'm banned" assumption even more expensive. The phase-out isn't all or nothing. You now know why the mistake happens. Next is the part that stings. What phase-out really means, and how many years of tax-free space you can lose just by assuming. Because phase-out isn't a vibe. It's math. And the math is where the quiet loss happens. Here's the concept. Roth eligibility usually fades out across a range. Meaning you can be too high for the full amount and still be allowed to put in something. But people hear income limit, picture a hard stop, and never even check whether they were in the middle. The IRS literally provides a proportional calculation in Publication 590A. The reduced contribution is figured by taking the top of the phase-out range minus your MAGI, dividing by the width of the range, then multiplying by the max contribution. So if you're single and your MAGI is $150,000 in a year where the phase-out is $138,000 to $153,000, the math works like this. 153,000 minus 150,000 divided by 15,000 times $6,500 equals $1,300. Now picture a mid-career couple. Good jobs, busy life. They assume they're over, so they skip 2 or 3 years. Later they learn they were hovering near the line the whole time. Some years they could have contributed partially. Some years fully. But they can't go back and reclaim that Roth space like it was a missed coupon, and that's the real penalty. Not jail. Not an IRS letter. Just permanent lost tax-free shelter that could have been compounding quietly in the background. So what do you do with that? You stop guessing. You install a simple process that tells you, in plain English, whether the door is open, halfway open, or closed. Here's exactly what to do. Not theory. Steps you can run in 20 minutes. Step 1. Find your AGI on last year's tax return. That's your baseline, not your salary, not your total pay. The actual tax number. Step 2. Estimate this year's AGI, MAGI early. Use a reputable Roth IRA contribution calculator or a tax software preview. You're not trying to be perfect. You're trying to avoid the April surprise. Step 3. Identify the levers you still control before year-end. 401k elections. HSA contributions if you're eligible. Payroll deductions you set once and forgot. These don't just change your taxes. They can change whether you're inside the phase-out range. Step 4. Check your filing status and the IRS phase-out range, then classify yourself. Full, partial, or none. If you're full or partial, set a monthly auto-transfer so you don't miss the calendar window. Step 5. If you truly end up over the limit, don't force it. Pause contributions until you confirm. And if you already contributed and later learn you're over, contact your IRA custodian or a tax pro to fix the excess contribution properly. If this helped, you'll want the next video on what to do when you're actually over the limit, without creating a tax mess. Subscribe if you want more of the system's rules explained like this. And drop a comment with your filing status and the number you used, salary, household income, or MAGI.